Well, hi, it's Chris here from Hunter Wealth, and welcome to another one of our Meet the Fund Manager investment series. Today I'm kindly hosted by BetaShares. BetaShares was founded back in 2009, manage over $75 billion in assets, and are a specialist in the exchange-traded fund space. They look at assets across cash, fixed income, property, Australian shares, international shares, and then have individual ETFs on things like artificial intelligence, Bitcoin, etc. Today, I'm kindly joined by their Chief Economist, David Bassanese.
Good
Thanks
to see
for
you
having
again,
me.
mate. Yeah.
I've interviewed David many occasions, so I always look forward to your insights, certainly around markets where you think they are. Majority of the time, you tend to pick it.
Oh, well.
Not always, but
Well, thank
generally,
you.
you do right for the fin, and you've been in major papers, and we certainly respect your time. So I look forward to this interview today. Obviously, markets have been trading pretty high, even with headwinds like geopolitics, inflation, the Trump factor, etc. It hasn't necessarily corresponded into higher returns for clients, certainly with the latest software sell-off, AI disruption, etc. But back to that in a minute. I guess my first question is, obviously, February interest rate, we've had a hike, 0.25. We're the first central bank globally, I think, to do that. Where are interest rates going exactly, and how many?
Well, look, it does all come down to the inflation numbers. I mean, basically our economy has been recovering since late 24. We've had a nice economic upturn, but associated with it has been a rebound in inflation. The last couple of quarterly numbers were definitely on the high side. So the RBA, in response to that, did raise rates in February, and we get another quarterly CPI in late April. The trimmed mean measure, that's the underlying measure of inflation. The RBA themselves have a forecast of 0.9% as a quarterly increase, which if you annualise that is close to 4, so still too high. So if it does come in with the RBA's forecast, I think they probably will feel the need to raise rates again at the May meeting. The markets themselves have 1 to 2 further rate rises in there, not a lot, but at least a couple. I'm still hopeful that some of the inflation uptick last year was a one-off factor. We had the Ashes Test series, which boosted travel and transport. We had an uptick in new home prices because builders removed discounts that they previously had in, so that upward pressure won't be repeated. So it really does depend on those inflation numbers. If it comes in 0.8, 0.7 on the quarterly, they won't go in May. I think they'll hold off. And thereafter, I think inflation will start to moderate. We're seeing around the world inflation moderating, so I don't think Australia is necessarily going to be an outlier in that regard. So at worst, I think 2 more rate rises this year, but at best, maybe, depending on your situation, of course, some people benefit from higher interest rates, but there's a chance, it could be one and done. But probably there will be at least one more to come.
Okay, so yeah, like you said, probably good for deposit holders, but not good for mortgage holders.
Yeah.
A lot of our clients have exposure to the US. So how are you seeing the US economy?
There's an interesting divergence going on in the US. GDP growth, economic activity is still pretty solid, running at 2-3% pace above trend, whereas employment growth has slowed up. So it's choppy, but over the course of the last half of last year, been very little US employment growth. The unemployment rate's been ticking up. So you can look at that as a glass half empty, is that's a lead indicator of a broader economic weakness. More likely, I think it is a temporary factor due to the tariff uncertainty. I think businesses last year went on a bit of a hiring freeze. And also it could be the early signs of a productivity payoff from AI. So businesses are maybe finding with AI tools and whatnot, they maybe don't need to hire as many workers, which ultimately is good for inflation and good for profits and good for markets if the Fed responds by lowering rates. But overall, the economy is holding up pretty well. There are question marks around the labour market, but the inflation story, I should say, is still pretty good. I mean, inflation in the US is still a bit above the Fed's target, but if you strip out the tariff effects, underlying inflation is getting closer to 2%, which is the Fed's target. So at the moment, the markets there have 2 rate cuts still priced in for the US market, notwithstanding the solid GDP numbers, and that's because of that inflation story.
You mentioned Trump a couple of times.
You can't have an interview without mentioning him.
No. So obviously with the trade policies, Liberation Day last April, the market plummeted. They talk about this TACO trade Trump always chickens out. Will he always chicken out?
Well, we saw a good example of that with the Greenland. Earlier this year, he said, US wants to take over Greenland for national security purposes, apparently. And he threatened Europe with big increases in tariffs if they don't toe the line. Europe turned around and said, look, last year we rolled over. You increased tariffs on us and we didn't retaliate. But if you do it again, we are going to retaliate. For whatever reason, he did back down. So he's apparently done a deal on Greenland, but the tariff threat has been removed. So that was another example, I think, of him ultimately, chickening out, as we saw last year with a back down in tariffs.
I think a lot of people are making a lot of money on whenever he opens his mouth.
Buy the dip.
Yeah, I think so. Tell me, the Aussie dollar, like Liberation Day gain last year, I think, it was as low as 60 cents. It's now over 70 cents.
Yes.
Fair value, probably around 72. I think you've been calling 74.
Yeah.
Where do you think the Australian dollar's going? I know you guys have instruments for hedging too, but is it too late in the dance to hedge against an appreciating dollar, or what's your view there?
I think we're in the midst of an appreciation cycle for the Aussie dollar. So we've got, you mentioned 74 cents, maybe 75 cents. And the big story here is not so much the Aussie dollar, it's the US dollar. The US dollar is still very expensive from a long run perspective. It's started to come down. We think that we are basically almost like a battleship churning around. We've had an uptrend in the US dollar for 10 years on the back of US equity outperformance and the rise of the large caps. Now with a bit of AI disruption and uncertainty around the tech sector in the US, at least in terms of relative performance, we're starting to see the US market underperform a bit, and associated with that is a turning of the US dollar. And you've also got the Fed cutting rates, whereas we're at worst going to keep rates where they are. At best, probably keep rates where they are, not cut rates anytime soon. So various forces suggesting US dollar weakness and in turn Australian dollar strength. So from a long run perspective, it doesn't really matter. But in the short run, if you're investing in the US market and you're unhedged, you're likely to lose a bit of your return because of the currency. So you're getting some hedged exposure, certainly over the next year or so, would make sense.
Okay. What about the precious metal sort of area, silver and gold? I mean, obviously, silver is like gold on steroids, so they say. But what do you think of that sort of?
Yeah, broadly speaking, we still like gold, and to an extent as a result, silver. I mean, the gold story has been it's becoming the new safe haven. Like Bitcoin's obviously come off a lot. People are sort of gravitating to the relative security of gold in that. In the moment, and also with the US dollar weakening, the gold has been rallying as the tide has shifted on the US dollar. So yes, the gold price in particular went ballistic, late last year, went too far too fast. We've had a bit of a consolidation through January and into February, but we still see the trend is broadly up because we see the trend for the US dollar is broadly down, and we see the eccentricities of Donald Trump, if you like, not going away. So that'll be used as a hedge.
We started the conversation a little bit just around this whole artificial intelligence sort of area. So it has really been the tailwind, like you suggested, for the tech sector over in the US. So, and everyone talked about the Mag 7, et cetera. So where's all that heading? I mean,
yeah, so there's various elements to it. So firstly, AI was, when ChatGPT got launched in late 22, it was seen as a boon for the tech sector. Obviously, NVIDIA went crazy because they were supplying all the computer chips, and it was seen as a positive for the Mag 7.
That was a barometer late last year in their profit too, wasn't it? A lot of people were waiting for the profits out of NVIDIA.
Yes.
And if that had been a bad story, that whole tech sector would have come off.
NVIDIA is still in rude health. The question is trading at high valuations. Is that sustainable? But I think what we're seeing at the moment now is that, the CapEx rollout of the big companies is enormous. They can fund that. They've got a lot of cash flows, a lot of profits, but it does eat into their, the more that they spend on data centers, the less they can return to shareholders through share buybacks, for example. So it is impacting their financials at the margin. But I think the biggest story now is who is the winner from AI and who is a loser. And it doesn't just affect the tech sector. We saw recently Main Street companies like trucking companies, even financial services. There's disruption happening across many sectors. and that's starting to, add a bit more volatility to markets, I think, at the moment. Yeah.
Yep. And then just general, your view on markets. It's always difficult to predict. All the investment
Yes.
banks come out with various stories over the course of every year, and not too many of them get them completely right. But where do you see the market playing out this year?
Look, I think first and foremost, is there a risk of a recession anytime soon? I don't think so. I think the US, underpinned by data center rollout, underpinned by tax cuts which are supporting US consumers, the US economy likely to avoid recession. So that's if anything we get in the equity market is going to be a pullback. You only really get bear markets if you see a risk of recession. Don't see that. Corporate earnings outlook still very strong. What I think we may see is that valuations in the US market, which have become elevated, pull back a little, but valuations outside of the US catch up. And so we maybe see a bit of a relative performance shift toward non-US markets. But overall, markets, I think, still grinding higher on the back of solid corporate earnings. Bond yields at worst going sideways. Most central banks are still in a neutral to easing bias, and so that should support overall valuations as well. So valuations holding steady, earnings going up, and that should allow equities to continue grinding higher this year as they did last year.
Okay, it's an upbeat, optimistic view. David, thank you very much for sharing your insights.
Great to be with you again.
If you'd like to have some more information provided to you by around BetaShares, or simply just an update on your personal circumstances, give us a call on 9003 4100, and look forward to catching up with you next time. All the best.